Hi traders, welcome to this edition of Expert Market Analysis brought to you by Arante. This is generally a bi-weekly, so a review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the disclaimer, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be long-term fundamentals or short-term themes which increase or decrease in importance over time. I'll just let you have a look at the second disclaimer, and then we'll just get to what we hope to get through in the next 30 minutes or so. Our goal really is to break down all the market jargon and complexities that you do read about. So if you do have any questions, please do ask them along the way and write them in the box, and we'll hopefully answer those as we go, at least at the end of the webinar. Okay, it's Wednesday, May 7, just after 11 a.m. in London. So let's get to it. Here are today's topics. We'll just check out how markets are trading currently. We'll look at just this theme around stocks and where they are technically actually after this massive rebound that we've had. Quite surprising rebound, but whether that is pausing slightly now. We'll then briefly review last week's main risk events, which was essentially non-farm payrolls, obviously. We had the Bank of Japan meeting, also Eurozone inflation. Before then, looking at this week's main events. Today, of course, later on, we get the Fed meeting. And we also get the Bank of England meeting tomorrow. So first of all, yes, how markets are shaping up currently, and this current theme just around the stock market rebound really, and that pause. Got an interesting chart here really with this win streak, which we saw in the SP 500, 9 consecutive days of gains. You can see that is rarely seen and hasn't been seen since actually 2004, I think. So that's the last time we saw a streak of 9 winning days in the SP 500. Of course, after we looked at this phenomena, stocks have dipped, and this is where we are now. Markets otherwise, yeah, slightly unsettled because of more Trump trade comments. The health sector has been weak, but we did get AMD positive earnings. The volatility index, the VIX, is still elevated, actually above 20, 24, just above 24 now. Long-term average around 17. But obviously we spiked up to 60 the start of April on the tariff chaos, if you like. Now back, as I say, down, but still elevated a touch at 24. Fixed income, I'm just looking at narrow ranges, actually. Long US Treasury yields dipped yesterday after a strong US 10-year auction. And then in currencies, pretty quiet at the moment. The dollar very marginally higher on the day. Trying to make back some of the losses from yesterday. We've got sterling off actually, and the dollar better against the yen, the Swiss, and most currencies actually, although the euro is doing pretty much flat actually, but most other currencies, the dollar is pretty much stronger against, especially against the yen, up 0.6% dollar yen. I just want to first go to crude. Actually, we don't look at crude very much, but I just wanted to give you a sense of where that is at the moment. Just because it's had a big sell-off, and we've had news over the weekend of around OPEC Plus as well. So I just want to show you first of all a Brent crude chart, which we don't go into very much. But here it is. This is the weekly Brent crude chart, and you can just see levels that we haven't seen for quite some time, going back to 2021 really. We've obviously got the spike low, recent spike low at $58.24, and we're just sort of finding that as support and just hovering around here at the moment above $62. Really interesting, as I say, Brent has been suffering both on the supply and demand side. So on the supply side, we had that, well, originally we had OPEC plus surprising the market back in April, actually, was a surprise increase of over 400,000 barrels per day for May. That was above the scheduled increase of just 135,000. Then the past weekend, just gone, the group decided to go with a similarly actually aggressive supply increase for June. And that actually means that in the last 3 months, the group actually has decided to bring back nearly 1 million barrels per day of supply. Yes, and then the Saudis are also threatening more big supply increases if members don't stick to their targets. That's a big deal for them at the moment. So the market's, struggling with this supply issue, and then also hurting, of course, from major demand uncertainty, of course, around tariff risks. And we've seen, if we just go to the monthly, that big breakdown in prices last month, which took us through support around $68. And now, as I said, that spike close 58.24, and you've got a major retracement at 62.05 there. That's from this low back in 2020 up to the spike high in 2022. So yeah, you've got a fib level at 62.05, key level at 58.24, and we're just trading above $62 at the moment in crude. Just interesting with both sides, supply and demand, but then prices finding support at the minute. Otherwise, if we move on to stocks, and I'll just pull up S&P 500 chart. Interesting times for stocks. Just before we get to the US, actually, European stocks, well, they closed lower actually yesterday and are slightly lower today, despite the election of Friedrich Merz as German Chancellor. That came on the second vote yesterday. Consumer discretionary weighed heavily, actually led by declines in L'Oreal. And interestingly, Novo Nordisk fell nearly 4% actually ahead of earnings. While other stocks, Intesa and Ferrari, gained on positive results. The DAX recovered partly after early heavy losses linked to that German political uncertainty I've just mentioned. If we just, before we look at some of the US stocks, we'll look at the DAX first of all, just finding resistance at the previous all-time high at 23,476. You can see there, you can see that pretty long-legged candle here with a rejection of prices once Merz was lower prices, sorry, once Merz was confirmed as Chancellor, but we're just below that 23,476 level in the DAX. Interesting, the FTSE, you can see here, has had a record 16 straight sessions of gains, the longest streak on record actually in the FTSE 100. Investors, though, are cautious ahead of the Fed decision, and we've had mixed corporate news as well. Obviously, we've had hints of a US-UK trade deal nearing finalization, potentially easing steel and automotive tariffs. We've had the UK-India trade deal as well being announced just yesterday, I think. And then we've obviously had a lot of noise around EU-UK closer cooperation. Potentially, that could help the Chancellor in her November budget if that means there are adjustments to growth, positive adjustments to growth going forward. So yeah, positive news in the UK. That's helped the FTSE, 16 consecutive days of gains, although we're down now 0.34%. And you can just see if we pull this back, we're just up to that interesting 78.6 retrace level of this move from the record high in March down to obviously that spike low in April. Yeah, with that 78.6 fib level, minor fib level being at 86.16, and that's where we found some resistance at the moment. Otherwise, Asian markets, well, they mostly rose today. Actually, optimism again surrounding US-China trade talks and China's monetary policy easing. The Hang Seng led gains, actually, bolstered by strong economic data and actually reduced reserve requirements from China's central bank. Indian markets cautious yet resilient amid obviously heightened tensions with Pakistan. Japan came back, that was up 0.3%, and then the Aussie was up 0.2% roughly. edged up, yeah, mostly ahead of course, this Fed meeting. US equities then, if we just look at those briefly, obviously last week we had, and the previous week we've had lots of mega cap tech earnings. The outcome really kind of logical. So we had Meta and Microsoft, who mostly do not partake in the production or shipment of physical goods, so they did well, whereas Apple and Amazon, who obviously suffer from tariffs because they do ship goods, basically they didn't do as well. Although Amazon did come back quite nicely as the market rallied and people really realized that they make much of their money now, of course, selling cloud services. And really, their goods from China are only 50% of their third-party sales. The other key takeaway probably from these results, these earnings, was that AI CapEx, so AI capital expenditure, is not dead. So Microsoft, Meta, and others all spoke more of a shortage of AI build-out capacity than a glut in that. So yeah, just a few very brief takeaways from those mega cap tech earnings last week. Otherwise, US equities, well, they fell yesterday down, the S&P down 0.77%, NASDAQ down 0.87%, Dow 0.95%. Just still uncertainty, of course, around Trump's really quite ambiguous stance on trade deals. And also we had a record trade deficit, 140.5 billion in March. Healthcare sector, that led the underperformance rate. Essentially, Moderna was actually down over 12%, Eli Lilly off 5.5%. There were rumors that there would be an appointment to one of the government bodies, the FDA, with someone who is not that favorable to the FDA. So that would be interesting. And that dragged the whole sector down. And then after hours, actually, we did have AMD shares rising 2% on strong earnings, although Rivian and Palantir slipped on outlook concerns. Futures at the moment, there are positive, really, just all around US trade talks and US-China trade negotiations, which are taking place in Switzerland at some point this week, I believe. Okay, technicals though, you can see, yeah, we're up to the 61.8 retrace level, 56.46, found some resistance there, and we're just off that. We've got the blue line, which is the 50-day moving average at 55.67, and then if we do break the top side, you've got the 200-day moving average at 57.46. On the NASDAQ, similar, tapped actually the 200-day moving average. So that's now at 20,177. And then we've rolled over the last 3 days, actually. Found resistance again as well at the 61.8. That's just above 20,000. So you've got support probably around 19,425 and 19,382, which is the halfway point of that sell-off. Otherwise, the Dow didn't make the 50-day, and we're just barely touched the, didn't make the 200-day and barely through the 50-day. That's now at 41,191. That is resistance. And we've got the halfway point of 40,833. If we do break to the top side, then the 61.8 is at 41,829. Otherwise, 38.2 is below 40,000 actually in the Dow. Okay, let's move on now to last week's main events. So we had, of course, non-farm payrolls first up, and then we'll look at the Bank of Japan meeting and also Eurozone inflation. First up, NFP. This is just a review of the key numbers. So yeah, the headline was stronger than expected, 177 versus a forecast 138. And also then against the previous number of 185. Which was revised down by 58,000. Unemployment, that was steady at 4.2, but interestingly, earnings growth actually slowed 0.1 to 0.2% from 0.3%, and the year-on-year was 3.8 versus an expected 3.9, I think. Interesting, labour supply experienced a significant increase of 518,000. So while Trump's immigration policies are starting to have an effect on foreign-born labour supply, that dropped 700,000. Domestic labour supply increased very sharply, up 1.2 million. So all in all, the report, well, it was solid, of course. It saw euro dollar go lower, US Treasury yields go higher. Markets really now fully priced out any change for the Fed this week, of course, and they flipped really. So there was above a 60% chance of a rate cut before the non-farm payroll data. Now there is above a 60% chance of no change at the June Fed rate meeting, the decision. Really then hiring and firing both remain subdued for now in the jobs market, but the risk is for weaker numbers probably May, June as the tariff reaction from business materializes. Interesting though, we do have this difference between hard data, which is solid, and then the soft data. By that we mean sort of sentiment surveys, more forward-looking data. For example, the University of Michigan survey and also the ISM Employment Services data, that survey as well. They are showing major concerns over labour market prospects and the outlook for the labour market. So we're not seeing that in hard data just yet, but very much so in the softer survey data. Okay, that was non-farm payrolls. Otherwise, we had the Bank of Japan meeting. So if I just pull up dollar yen chart, actually, which is just picking up actually from a couple of days of selling. Yeah, the Bank of Japan, well, as expected, they left rates unchanged. Same time, we did have growth and inflation forecasts, so they cut the outlook for growth by 0.6 percentage points, 0.6 decimal points really in this year, and then 0.3 in financial year next year. Basically blaming the trade war. Inflation forecasts, they were also cut by 0.2% to 2.2% for this year, and then 0.3% for fiscal year 26. And then the new 27 forecast for inflation is 1.9%. Policy statement, that was really very short. So there was no mention that the Bank of Japan still expects to hike rates further down the road. That is perhaps why dollar yen traded quite a bit higher, actually, from 143.10 to 143.70. JGB yields, they traded low on the back of the decision. Essentially, the Bank of Japan kind of needs to walk a fine line these days, postponing further rate hikes because of the trade war uncertainty, but still sounding hawkish enough, really, to not weaken the yen too much. And that is certainly not desirable during trade negotiations, which are taking place, of course, with the US at the moment. Of course, otherwise, we do have solid wage growth this year. Reflating the economy is on track. But then against that, Governor Ueda stressed, of course, extreme uncertainty regarding trade and then also the growth outlook. Of course, though, with those latest forecasts, they're still close to potential GDP, with inflation expected to rise still to still 2.2% for this year. Then really the Bank of Japan do seem bottom line to have maintained its plan to normalize policy. That means a rate cut probably July or later on. Much will be down to how tariff and trade policy evolves. A wait and see stance is obviously being adopted by the Bank of Japan. But obviously any positivity in those trade and tariff talks, then potentially July hike, possibly, or a September hike if we do get positive noise. Just on the yen, there is very, very big long yen positioning by big funds and by speculators as well. So probably the biggest threat to this downtrend in dollar yen is probably an unwinding of those long yen positions. At the moment, you can just see we've kept in this descending channel, bear channel, lower lows, lower highs, has broken out to the top side, but then back into it, and we just kept it there for your guide, really. Interestingly, we did move back into it. You can see yesterday after 3 days of selling, but then we've just picked up a bid today. Levels then, we've got sort of major support around 140, 139.57, and then resistance, well, this should be moved actually really. So that would be 23.6 at 144.33. Above that, a 50-day at 146.48, and then this would be the 38.2 retrace if you're taking it from this high to this low, pretty much around sort of 148, just above 148 in dollar yen. We'll move on to Eurozone inflation as well. That came out last week, and the headline remained at 2.2, actually, slightly above the consensus estimate of 2.1, but down from, well, 2.5% in January, so closer to the 2% target of the ECB. That was due to core inflation, actually, which rose more than expected at 2.7 from 2.4 in March. That's basically because of Easter occurring in April. Expectations then are for the headline to average just above the 2% target in the coming months, and that kind of supports further rate cuts from the ECB at the next 3 meetings. Trade turmoil, of course, will impact, and potentially in the Eurozone, that means a disinflationary impact. So that means inflation going lower, especially with energy prices down, and also the euro well above 112. Also, we've had postponed retaliatory measures from the European Commission and pressure on European prices as well from Chinese goods, which are increasingly locked out, of course, of the European market and moving towards Europe. That means goods inflation not set to experience more of a price increase in the months ahead. But of course, the outlook is very uncertain. And certainly, if you do get a reshaping of the global trade order, then we could have sort of inflationary effects as well. So two-sided for the Eurozone, but more disinflation impact seen at the moment, potentially. There is no major data in the Eurozone this week, really, so we'll just be on the lookout for any ECB communication from officials. Generally, that has been dovish, really. Little pushback versus markets. Speculating for rates to fall near to 1.5% from the current 2.25% for this year. So 75 basis point cuts are being looked at by markets from the ECB. For the euro, of course, that's benefited from this move out of US dollar denominated assets. But it is interesting, a stronger euro due to factors not related to basically short-term rates argues probably for even more ECB rate cuts. Euro dollar, then you can just see the high. It was at 115.72. That's a 3-year high, I think, and we're just sort of oscillating around 113.50 or so. Support probably around 112.65, just a touch lower, 112.63. And then, as I say, that sort of high for bulls to aim at above 115.70. Okay, that's euro dollar and all last week's main events. If we just now go to, of course, today and tomorrow, we get the Fed and then the Bank of England meeting. If we just look at the Fed meeting first of all, wait and see mode, basically. This is the FOMC first time they're meeting actually since President Trump's Liberation Day. Of course, the administration has since kind of provided the world at least with a reprieve from those extreme tariffs first announced. But really, we've seen in consumer inflation expectations and also initial repricing decisions by US retailers that will back the FOMC guidance that inflation remains their top priority. If I just move to this chart here, you can just see how inflation expectations over 1 year and 5 years ahead, they've spiked higher, you can see, and that is due to tariffs, of course, really sparking concerns around inflation going forward. And that is what the FOMC is likely to emphasize at today's meeting. That will be their top priority and also their major risk. Otherwise, they are mindful, of course, of the negative effects, if you like, on activity and labor demand of tariffs. But as I say, expectations are for inflation to be emphasized as the main focus. I've just put in a few different numbers here of the GDP number, of course, which shrunk recently in Q1, but that was basically undermined by a surge in imports with front loading of purchases ahead of tariffs. We've had the non-farm payroll, of course, being relatively solid, pretty strong, and that is hard data, but backward-looking data. And as I say, there is this difference between the hard data and also then the soft data, which is showing much more negative outlook going forward. There aren't any updates to forecasts at the Fed meeting today, and so guidance really is likely to imply, if anything, that rate cuts are off the agenda until the second half of this year, and that, of course, will be further resistance against the pressure that President Trump has been putting on about really wanting to see a rate cut. As I say, wait and see stance very likely. Jerome Powell has been recently warning that unemployment looks set to rise, with the economic impact from tariffs likely to be larger than previously thought. However, he has said the labour market is in decent shape, and we've just showed you that really with the recent non-farm payroll reports. Although Powell has signaled that the US can't have a strong labour market without price stability. We have heard from other officials as well. Governor Waller, who is sort of seen as a sort of consensus voice at the FOMC, he said a move is unlikely in June due to the 90-day pause and there won't be enough data, and then emphasized that the outlook is highly uncertain, but that potentially inflation would be transitory, that word, and then the Fed could potentially look through that with rate cuts further out. It does also, and I know other officials have also mentioned that, yes, they are worried about the supply shock overlaying tariff induced price hikes, but then there will be a negative impact on consumer business sentiment, and that will impact growth going forward. That does leave stagflation in play, basically, so stagnant growth with rising prices, but really it's how long elevated inflation persists, which is the key. And of course, then this hard and soft data divergence, if you like. Interestingly, going forward, we would point out that housing is 40% of the CPI basket, and potentially if we do get a cooler economy and we do get cooler rents, and that would affect CPI going forward, potentially quicker than many think. And then potentially a cooler economy, of course, means deteriorating labour market at some point, and that would then limit wage gains as well. Just a couple of charts for the Fed. We just see, Fed funds rate just ticking lower, but obviously PCE slightly elevated and still potentially going higher with these tariffs. And then I've showed you those inflation expectations spiking higher, and that's obviously playing into Fed officials' minds and what they want to focus on most immediately. If we just look at the dollar index, if I just pull up this chart, which is here. I always say this, but the weighting in this index, the euro has by far the biggest weighting, 56% or so. So this is kind of mirror image of the euro if you just turn it upside down. So we've still got this big dotted line in here, which is this level from back in 2023, 99.57. Is the big level for us, and we've been trading around it. So you can just see the importance of that as a sort of pivot point. If we do break higher, then we've got 161, which is sort of capped the downside on a few occasions previously. But we are still really in this sort of descending channel again. And then you've got that low from April at 97.92. Interestingly, with the dollar, obviously it moves generally in line with short-dated US Treasury yields, the two-year yields especially, but it could be different now. So, for example, if the Fed does drag its feet on an easing cycle, that could hit US equities, and once again, we see a demand for a higher risk premium of the dollar possibly. There are, as I say, around, as I put there, around 80 basis points of rate cuts priced in for this year, and the chances of a move in June have been pushed out on the back of that solid non-farm data that we saw on Friday. Of course, rebounding stocks, more positive Trump would also help potentially take some of the financial risk premium out of the dollar as well. But at the moment, we're just sort of hanging around these key levels. Okay, let's just move on now to the Bank of England meeting. I'm just pulling up the cable chart. So this is sterling against the dollar, of course. Meeting takes place tomorrow. Consensus unanimously expects the MPC to cut rates, actually the base rate, by 25 basis points to 4.25% from 4.5%. Markets fully priced for that. Decision expected to be 9-0, although some possibly expect the external member Dingra to back a larger 50 basis point rate cut. The move, though, would be in fitting really with the bank's preferred pace of cutting, which is basically at every other meeting. So a meeting with an MPR monetary policy report is how basically we are reading how and when the Bank of England reacts. That is every quarter, so every other meeting when the Bank of England at the moment is seen as cutting rates. Most interest will be on then how the MPC positions itself for rate cuts going forward, if it does follow that plan, if you like. They're likely to be gradual and careful, and use that phrase again, but restrictive could remain in place. If they do drop that gradual and careful language, then that could then provide the MPC with space to accelerate cuts if needed, and that would be probably a dovish sign if they did drop that gradual and careful wording. Markets are pricing in 3 cuts at the next 4 meetings, largely linked to the Fed and really not the domestic story. So we'd probably need to see the economic outlook in the UK materially deteriorate to see that, and then a US recession potentially impact UK services. Because of course UK goods unlikely to see much direct impact from tariffs. Also, there is, of course, focus on services inflation that remains particularly stubborn in the UK, despite expectations that it is expected to decline. And then for the MPR, so the monetary policy report that's basically updated quarterly forecasts. Expectations are for a reduction in the 2025 inflation forecast, basically on lower energy, and then an upgrade to the 2025 growth forecast due to the better run of data we've seen in this first quarter. So that is the Bank of England. You can just see cable doing well, as we mentioned, a lot to do with the trade deals, of course, with the US, with India, and also closer ties with Europe potentially. You've got the highs at 134.43. That looks like decent resistance. Those recent highs, which tally with those highs from September, which were just a touch below at 134.34. So that should offer a decent resistance zone. Otherwise, support's probably around sort of 132.30 in cable. Okay, we'll wrap it up there. Thank you so much for being on the call. Really do appreciate your time, and hopefully that's proved of use to you guys. A few interesting central bank meetings coming up, of course, and then all about trade headlines and positive headlines potentially out of Donald Trump and the White House going forward. We will speak to you in a couple of weeks' time. Take care, and best of luck.